Hello friends, Namaskar and welcome all of you to my channel. Today let's discuss about the term that is the spontaneous source of financing, what it means and why it matters in business. Basically, I believe that the context of working capital financing, and this is the one of the important sources of financing. You can say that even though that could be important for the even the new company and even the established company too. But the important point is that for new company, spontaneous sources of financing may be challenge for them. And based on this background, let's move to the discussion on first of all, under spontaneous financing, friends, you have to understand the two terminology. That is the one is trade credit and next one is the accrual. And I believe that today's discussion would be just I would cover spontaneous sources of financing, and you could see this picture that is all about sources of short-term financing, which could be categorized into one is unsecured sources and next one is secured sources. Under unsecured, again it could be categorized into two, that is the spontaneous and next one is the non-spontaneous. Under spontaneous, today I would just cover trade credit, which is also known as account payable, and next one is the accrual. In coming days, I will also discuss about the what about the bank loan and the commercial paper under the non-spontaneous, and at the same time, I would discuss the account receivable inventory financing in coming days. That is under the secured sources, friends. And as we know that this is trade credit refers to the credit extended by the supplier of the goods and services, which is normal course of business. Even though so many suppliers say that they don't want to sell the goods on credit, but market is so competitive, they can't say that they would not sell the goods and services on the credit. They have to take the credit risks too, right? So I believe that today's discussion would be important from the buyer point of view, at the same time seller, yeah, supplier point of view also, friends. So as per trade practices, the cash is not paid immediately for purchase, but after an agreed price, agreed you can say that price, yeah, period of time is all about is the relationship between buyer and seller. So friends, that's a deferral of the payment could be called as a trade credit here, which represent the sources of finance for credit purchase, and it seems to be informal arrangement because this is not the formal, while in case of secured, yeah, bank loan and the commercial paper, these all are the financial arrangement, right, which is formal. So it's very important, it's informal, but important point is that it creates the legally enforceable obligations on the buyer of the goods to pay on the majority, whereas account payable have more flexible payment obligations, right? Then now the question is about obtaining the trade credit. We say that, yeah, accounts payable. Now how do the suppliers look for in granting the trade credit? That means how the suppliers decide about, yeah, what particular variables they could take into account. So you could understand this is your earnings records over a period of time. That means earnings records of your customer, yeah, debtors, you can say that, debtors liquidity positions, record payment, like that. But challenge is that, friends, if you are a new, let's see the new customer for that vendor, yeah, supplier, then it might be the challenging for you to obtain the trade credit. Okay, now the question is about how we could cultivate, yeah, that's cultivating the good supplier relationship, because the question is about we buy the goods and services on the credit, but we have to pay the dues amount on time so that we could maintain a good relationship, right? So the question challenge is that well established successful enterprises may not have so much difficulty in obtaining the trade credit, while new company, yeah, startup, you can say that they might have, yeah, one with financial problems will probably face difficulty in obtaining it. And the confidence of the supplier is very important. You must gain the confidence of the supplier so that in coming days when you meet your obligations, right, then in suppliers will provide you, yeah, supply the goods and services on the credit. So it is better to make moderate commitment here. Sometime what will happen, just for example, which may not be fully satisfying to the suppliers, and honor them rather than make like a tall promise. Sometimes we promise lots of things but we are unable to meet that obligation. So it's important to, at least we need to understand our own ability to take the credit risks also, friends, right? Here seller would sell the goods on the credit, that means they are taking credit risks, but at the same time, if buyers ability to meet its short-term obligation not good, then in that case supply customers may have a problem and ultimately it will affect suppliers conditions too, right? Now let's move to the what about the, yeah, that is a spontaneous sources. As I explained earlier, there we could say that spontaneous sources could be like a trade credit, or you can say that as account payable, yeah, accrual, wages payable, tax payable, rent payable, whatever. Okay. Now next one is that there is normally no explicit cost attached to either of these, that is the trade credit and account payable. But note that the trade credit is the most important, that is the trade credit is the most important, unsecured, and carrying spontaneous sources of short term financing here. Okay, unsecured, that is not backed by any collateral or the mortgage, we see that like a bank loan and other sources of funds. While non interest bearing means you don't need to pay interest to the supplier. Okay, now the question is about how we could define the cost of trade credit. Okay, so important, you need to understand here that's credit term, right? Seller would provide you the credit term, for example 2 by 10 net 30. That means if the customer, yeah, debtors would make the payment within 10 days, would enjoy the 2% cash discount, right? But if that customer would not make payment within that discount period, that means that would be the opportunity cost to the customer here. Okay, so here supplier would provide you this type of your facilities basically to induce the early payment, that you need to understand here. Now the formula is that you could say that as the cost or annual percentage basis of not taking discount. If the customers could not take the discount, then in that case that could be the cost to the customers, yeah, debtors. Okay, so that is the discount percentage divided by 1 minus discount percentage into number of days in a years divided by credit period minus discount period. Okay, now effective rate of foregoing the cash discount, just you have to consider this equation: 1 plus discount percentage, 1 minus discount percentage whole to the power. If I would say the number of days in a year is 360, then divided by number of extra days to make the payment minus 1. Number of extra days to payment, friends, that is all about credit period minus discount period. Now let me clarify about the one interesting example which could clarify you at least from the buyer perspective, yeah, seller perspective, you could understand the things. Now if this is the case, the firm makes the payment of the 1000 purchase, right, on the credit, and the credit begins at this March 1st, and this is for 1 month, right? So if the cost, if I would assume that 2 by 10 net 30, if the customer would make payment within 10 days, would enjoy the 2% cash discount. Okay, so in this case at first we need to understand here, like if you record your journal entry at this date March 1st, so in the book of buyer this would be recorded as a journal entry purchase account debit to account payable, like that. Okay, account payable account, that is this is debit and this is the credit. Okay, now if the customer, let's assume that make the payment on the March 1st, March 1st we record it, now March 10. So March 10, then account payable account debit to cash account, but this, since this is the 980, because you would enjoy the 2% discount, that is 2% of 1000, that is a 20. So look at your accounting equation again, that is A equals to L plus E. So purchase being the goods, you can say that this is the purchase, is the, or like your inventory is the assets, so is the positive, while accounts payable, your liability, current liability will increase, so account payable is 980. But at the time of making payment, account payable to cash, so accounting equation would be cash outflow would be there, so 980, and while your liability will, short term liability, that's account payable, will reduce by 980. Okay, now again let me clarify about how we find the cost of trade credit, friends. That is the discount percentage, that is 0.02 divided by 1 minus 0.02 into, if I would say that number of days in years, that is a 365. So 9, this is 30 days minus 10 days, you will get in fraction, and then you multiply with 100, so 37.24%. Now if the question is about, yeah, effective rate of following the cash discount, so in this case you do like this: 1 plus discount percentage divided by 1 minus discount, right, percentage, whole to the power number of days in year divided by, that is the, yeah, additional day, that is the credit period minus discount period. This is 30 minus 10, overall minus 1. So in this case you would have this value minus 1, so if you multiply with 100, that is a 44.59%, friends. Okay, now this is very important when you study financial management, corporate finance, then even we in financial accounting we also discuss about, yeah, this journal entry, the concept of credit term too. Now the next question is that, is it good for of stretching the account payable? Now from the buyer perspective, yeah, we know that, yeah, despite no explicit cost associated with the trade credit, if we stretch the payable, there will be possible cost to the buyer too, like cost of cash discount, because you could not enjoy your cash discount, that could be opposite cost to you. Late payment, penalties or interest, and worsening in credit rating. You may have a bad relations with the suppliers, so in coming days that supplier may not supply just with the perception that your overall credit rating is not good. Okay, so it's very important, we have to pay the dues figure on time. Next one is that, who bear the cost of the funds for trade credit? Okay, one is the suppliers. When trade cost cannot be passed on to the buyer because of price competition, the market is so competitive, yeah, demand is high, so in that case to you may follow the liberal credit policy to induce your sales. Okay, that is the case. Next one is the buyers. When cost cannot be fully passed on through the higher prices to the buyer, can be passed away, that means when the cost can be fully passed on through the higher prices, since supplier took the credit risk, so supplier may charge high price to compensate that credit risk. Okay, so that is the case. Both might be the case when the cost can partially be passed on to buyers by the seller, like that. Okay, this is the all about the concept of credit term, yeah, accounts payable. Now next one is that, friends, that is the accrued expenses, is all about the second source of spontaneous financing, is the accrual, which simply represent the short term liabilities, you can say that, for service that have been provided to the firm but payment has not yet been made. For example, let's see the outstanding salary. Okay, outstanding wages, yeah, tax payable, like that. Okay, these all are the accrued liability, yeah, expenses in balance sheet under current liability sections. So we record trade credit, yeah, accounts payable, accrued expenses, like that, friends. Okay, now basically today we discuss about the concept of, that is the spontaneous sources of financing, and I believe that it would definitely enrich your understanding level of your trade credit and the accrual expenses too, friends. If you really like this content, please like, subscribe, and also share my channel, that is the Finance Guru Pawan Kumar Jha. Thank you all of you for watching this video. Please take care all of you. Thank you.